Hello, everyone. Today on the Final Bar, it's Monday, so we'll break the market down by three directions. Top-down macro, we'll talk about the big picture, really choppiness in the major equity averages, selling off through the course of the day, but rallying back going into the close with the NASDAQ 100 finishing in the green. We'll talk about sector rotation. It's really energy versus everything else, but if gold was its own sector, it would be number two. Finally, individual stocks, a number of names reporting earnings, and a number of them breaking above recent swing highs. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of technical analysis, using the technical toolkit to better quantify investor behavior, better understand market dynamics, and anticipate where things may be headed next. Now, as we've talked about for many moons now, it's all about a choppy market environment, a sloppy market, as short-term movements are pretty rapid. Volatility is elevated, so we have the VIX teasing 30, if not a little bit above there at the close today. And so altogether, what do you do as an equity investor? Well, the good news is there are pockets of the equity markets that are actually doing just fine. If we look at energy stocks, obviously up over 20% year to date. Gold stocks starting to improve. Other materials names like agriculture stocks doing just fine. So there are pockets within the equity landscape that are doing just fine, but there are others that are struggling quite a bit. A number of them with the potential to bounce this week. So you have things like renewable energy bouncing today. And we'll take a look a little later in today's show at some of those individual names on the move. Also financials rolling over to the downside going into to today's close. We have great guests on the show. I'm always so thankful for the conversations we're able to have with some of the market's top technical analysts and strategists. This week, we have some really good guests lined up for you. Tomorrow, on Tuesday the 1st, we have Dale Pinkert joining us again on the show. On Wednesday the 2nd, Craig Johnson from Piper Sandler in Minneapolis. And then on Thursday the 3rd, my former Fidelity colleague, John Gagliardi, joining us from the Northeast to share his take on the overall market environment. Let's continue on with today's show with our market recap. We start big picture, so we'll look at the top-down macro point of view, and we'll look at the dashboard to start with. And if you look, the S&P, really choppy down through most of the course of the day. And in the early afternoon, as we start preparing for the show, the S&P making a new low for the day. Going into the close, it was sort of reverted back to the upside. And while previous days, Friday actually showed some strength going into close as well. Some of the days last week, you saw quite a bit of distribution going into the end of the day. Today and Friday, you actually saw the opposite, which is actually sort of a short-term encouraging sign. It's encouraging to see demand come in going into the close. That usually indicates some buying power coming in, usually from institutions. Today's the last day of the month. So it could be a bit of a window dressing type of thing, usually more of a quarterly end. You would think of that sort of thing. But I thought it was worth noting. The S&P, by the way, finishing down 0.25% today. After all was said and done, the NASDAQ composite up 0.4%, the Dow down 0.5%. Mid-caps were flat for the day. The small cap S&P 600 index up 0.4%. And the VIX right almost exactly at 30. Other asset classes, and then we'll look at some of those charts of those other asset classes. So bonds moving higher today, and that's why the 10-year yield is coming off. On Friday, it was right around 2% on the 10-year yield. Today, it's finishing the day around 184. Now, what's actually happening there is yields come down when bond prices are going up. The TLT, which we usually use as a proxy for bond prices, was up about 2%. And so this is sort of a flight to safety sort of move when you see U.S. Treasury bonds going up so much, and so that's going to push yields down quite a bit. It's interesting how poorly financial stocks have been performing. They have been doing very, very well to a point last year, but in the last couple of months, you're starting to see some internal weakness. We'll highlight a couple of those if we have time. I was looking at Citigroup, State Street, And these are ones that are actually failing to hold support. And so it's worth paying attention to some of those breakdowns and make sure you have your risk clearly defined in those sorts of charts. Looking at the commodity markets, the DBC, which is a broad commodity ETF, was up 1.7%. Gold and silver both up about 1%. And we're going to look at the chart of gold here in a few minutes because I think it's an important one to pay attention to. Energy prices, obviously, a key story related to Ukraine and Russia and all the events unfolding in Europe right now. Very little, I mean, most of the things I'm seeing have the implication of higher energy prices, and we're certainly seeing that manifests itself. And you're seeing that with energy stocks obviously doing very well as a result of this ongoing conflict. Cryptocurrencies really accelerating to the upside. They sort of moved higher earlier today and just accelerating to where we're at right now. Bitcoin is actually approaching 42,000, a level it hasn't quite seen in quite a bit. Ether up 8%. All 10 of the top 10 coins that we track on StockCharts all up. Many of them, or a number of them, starting to be in double digits from yesterday. So over the weekend, you're seeing now a rotation back to the upside. And again, it's hard. Again, I think you can think of these as sort of a risk-on measure, but certainly seem to be moving independently from other asset classes in a lot of ways, really becoming their own asset class altogether. Now let's look at some of these key charts and see what the macro perspective looks like. When I'm looking at the S&P 500 chart on Friday and writing a note to my market misbehavior premium members, one of the points that we talked about was just this general pattern of weakening momentum. So, I would say, when you ask me when the market topped, even though the S&P itself made a new high in December and even made a higher high in January, I would argue the top, for all intents and purposes, was in November. That's when you had the peak in momentum. That's when you had a peak on a lot of the breadth indicators, a lot of individual stocks as well. And so even though the S&P went a little bit higher, the momentum has been steadily declining. And even in the last 4 weeks or so, when you've had a couple of these bounces, and the question is, are these bear market rallies or the beginning of something more significant? Are these recovery, the beginning of a deeper or a broader recovery where the S&P starts to regain some of its previous losses? I would look at this chart, and this chart of declining momentum tells me most of what I think is important. Until that changes, until you see price improve, on improving momentum, it's hard to get super excited about what's happening in the markets. Now, if you look at the chart of the S&P and think about where the closing prices are, so the low close here in late January was just about 4,300. In late February, we hit here around 42.30. We'll call it was the close there. We're now starting to see a bullish momentum divergence with lower lows in price, higher lows in RSI. That sort of supports that at the very least we get a buyable move here, or a short-term rally, a bear market rally. And I think that's certainly what we're seeing. Larry Williams last week, by the way, on StockCharts TV, and it's on our YouTube channel on StockCharts TV on demand, basically made the case that this is not a bear market rally. Basically, the bear market's over, and we're starting to be in a recovery phase. I hesitate to boldly disagree with Larry, but there's certainly a number of different perspectives, and I would take the opposite side of that. I think I haven't seen enough to sort of agree that we're in a recovery phase. I could see plenty of indications like bullish divergences, which tell you we could be there, but I would want to see the follow-through. I would want to see the upside momentum, the upside follow-through on price, which means the S&P needs to get above around 44.50. That would get us above the 200-day. That would get us above the first Fibonacci resistance level. Also get us above trendline resistance if you take the highs from January and February. If we would get that, you probably won't hear me give you an all clear until the S&P would get above 4,600. That would finally take it above the early February highs, which is now an established level of resistance and also key Fibonacci level. So at this point, again, it's a nice tradable bounce. I'm seeing plenty of stocks that are working, but when I think about the overall S&P, I still think the path of least resistance remains lower until proven otherwise. Now, quickly, let's look at another asset class or two. Bitcoin, I mentioned earlier, up pretty significantly, up over 10%. The challenge with the chart of Bitcoin, it reminds me of something like an airline or Las Vegas Sands, a gambling stock, for example, right? These are stocks that have had a pretty tough run of things, and now we're sort of in a sideways trend. So while it's interesting, it's good to get excited about a nice rally off of the lows, and I think what's encouraging for Bitcoin is you've now made a higher low. If you take the low from January, you now have a higher low in February. That's all encouraging, and if you do want to be aggressive about a chart like this, I would be thinking of that recent low as a stop, right? That low around 37,000 or so would be the sort of general bottoming point. That's the cluster of lows there. from February. You keep a stop there. That's actually not a bad, pretty compelling risk and reward after it's broken above the trend lines connecting the previous highs on Bitcoin. Just finally, very quickly before we get to sectors, I want to highlight the chart of gold. As I mentioned earlier, if gold stocks were their own sector, energy is up about 6%, maybe even more, given the rally that you saw today, up a couple percent, but it's up pretty significantly, getting closer and closer to 30% just year to date. Most other sectors are down, but if gold was its own sector, if you broke it out of materials, it would actually be the second best performing sector, up about 4% if you're looking at the XAU. So overall, one of the better places to be outside of energy. Obviously, very much related in terms of a commodity play, but don't count gold out. I know a lot of investors have not been thinking about gold because it hasn't been working for a long time. It's starting to work on a relative basis, maybe worth your attention. Our next segment is sector setups. We talked about the big picture, the sort of choppy environment in the equity markets, but starting to show some signs of life, potentially, as we process what I would still call a bear market rally. Let's look at the 11 S&P sectors and how they are rotating. We'll start with Julius de Kempener's RRG. And if you're not familiar with his methodology, he has a show on StockCharts TV called Sector Spotlight. He does such a great job of showing this methodology and going through a lot of the different permutations we rarely have time for on this show. So I'd encourage you to look at Julius and his articles to learn more about this. But basically, you're looking at the 11 S&P sectors and how they're rotating around the S&P, which is in the middle of those crosshairs there. Up and to the right, heading northeast, that's long and strong sector with improving performance. Only one of those really stands out as an outlier, and that's energy. Now, this is looking at weekly data. This is looking at a little more of a long-term data set, but it's certainly, it's sort of energy and everything else at this point. What else is looking, fairly constructive? Consumer staples would be number 2. Financials and utilities, I would say tied for third, all sort of in that leading quadrant, all generally heading to the right, which is good. You want to start getting concerned when they start heading south or southwest, because that tells you the momentum is alleviating, or the relative strength is starting to underwhelm, and the momentum is starting to come out of that trade as well. What's really ugly on this chart, not many, but I would say the weakest would be consumer discretionary, which is the only one of the 11 S&P sectors in the lagging quadrant. Really a rounding error away from the lagging quadrant is technology, which is here in yellow. Communication services still the weakest by the fact that it's furthest to the left. It's improving though, and so you're seeing some bombed out communication services stocks, or as a sector at least, starting to rotate more positive. It might be an interesting place to look for some opportunities. Also industrials, by the way, which is starting to improve there, coming into or toward the leading quadrant here very quickly. When we look at the 11 S&P sectors using the candle glance function, this is one of my favorite ways to think about any list of charts. If you have a chart list of ETFs or stocks or whatever, put them on the candle glance page, and then you can basically look at all of them at once. You can visually screen through that list of charts and see visually which charts are starting to look similar to one another, which ones are the outliers. And I'd ask you very simply, looking at this page of 12 charts, it's the 11 S&P sectors and then the S&P in the bottom right, do any of these stand out as looking very different than the rest? And to me, the answer to that is super straightforward, which is energy, right? It's the only one out of the 11 S&P sectors anywhere near an all-time high, and it's making one again today. So when you think about long-term bases, I'm thinking of the chart of the XLE with this basing pattern, surrounded by these shaded areas that occurred through much of 2021. You then broke out in fall of last year, tested the breakout level from above, and now rotating higher, and it just continues to push higher. You have a breakout, you'll have a consolidation phase, and then you sort of break out of that range to the upside. So I see a lot to continue to like there. And I'm often asked in that sort of scenario, did I miss it, right? Is it too late? And you have to remember that year to date, energy's up about 26, 27%. It was up 5%, and then 10%, and then 15%, and then 20%. So there have been a lot of places along the way where you could have argued it's overextended, but again, the trend doesn't really care what you think about the trend. It often continues, until it doesn't, until the chart tells you otherwise. I don't see anything on the chart of energy telling me that the trend is over. The chart will tell you when that trend is exhausted. I'm not seeing that yet. So while energy super strong, what else is starting to show signs of improvement? Not much, and that's the problem I'm having looking at equities. from the top down, when you look at the 11 S&P sectors, you see a lot not to like. You see things like communication services below 2 downward sloping moving averages. You could say the same for many S&P sectors. Materials might be another one below 2 downward sloping moving averages. Communication services is probably the most purely negative by the fact that it's below the 50-day, below the 200-day. They're all sloping downwards. That's kind of the classic bear market configuration if you're looking at price and 2 moving averages. The rest are sort of in this choppy no man's land between a beautiful uptrend, which is where you see energy, a beautiful downtrend, which is where you see communication services. Everything is sort of chopping around in the middle, which is why I tend to think of this sort of environment as a classic stock pickers market. I think there are plenty of stocks that are working just fine. There are plenty of areas of the market that are not working. And if you can lean into what's working and lean away from what's not working, hopefully you're able to navigate this okay. Now, a couple of sectors just to highlight before we take a quick commercial break. Financials are a tough one, and if you look at the XLF, while the XLE had a basing pattern, broke out of that basing pattern, and now rotating to the upside, financials are really just still in a choppy limbo sort of configuration. You're not seeing a lot of upside follow through on the XLF. To the contrary, you're seeing failed breakouts. So in January and February, both of those attempted to break above the October high, and both of those failed. And what that tells you is either there's an exhaustion of buyers, there's an influx of sellers. For whatever reason, we're pushing prices back down, and now it's once again testing the 200-day moving average, which it's done now twice here in the last couple months. Utilities are another interesting one as well. And what concerns me about the chart of utilities is it's starting to look better. And what I have found working with institutional money managers, you really don't own utilities unless you're trying to hide out. You own utilities basically so you cannot own other things. If you want to take a risk-off bet, you take your really risky stuff off and you park it in somewhere like utilities, which tends to pay a higher yield, pretty low volatility, fairly stable. You're not going to get crushed. You're not going to shoot the lights out owning utilities most likely, but you're probably not going to lose everything because there's enough of an income component, pretty low volatility. The fact that this sector is performing pretty well on a relative basis since early November. Remember what I said earlier about the market actually peaking in November. You're seeing the relative strength improve there. You're seeing it potentially break above a trend line resistance if you take the December and January, February highs. So overall, you're starting to see some flows into utilities. That may be an interesting chart to watch as well. We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we break down the market action using stock charts, using the technical toolkit to better quantify investor behavior. A couple quick announcements before we get to our next segment, Shifting Stocks. First off, we love to hear your feedback, but very much love to hear your questions. What are you running into as you're trying to analyze your own charts, break down your own portfolio, looking at particular stocks or ETFs or even technical indicators? Nothing's out of bounds. Just shoot us an email with your questions. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions and we'll hope to answer one of yours live on the air on Tuesday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. It is completely free. I mentioned earlier in today's episode a special market outlook event by Larry Williams last week. That is on StockCharts TV on demand. The Pitch, which aired last Thursday, I believe, also on demand there as well, and so much more. Go to StockChartsTV.com or on your mobile device, just search for StockCharts TV on demand. I want to continue on with our next segment, Shifting Stocks. We talked about the big picture, the S&P and the major averages chopping around, showing some renewed strength here in the short term. Still would consider this a bear market rally until the evidence tells me otherwise. About sectors, it's really energy and everything else. I would say gold is maybe a second to that in terms of showing long-term strength, but it's really all about energy. Now let's look at some of the individual names that are combining to form those sectors and those indexes we've talked about so far. We'll start with some pretty happy charts, and we'll start declining in terms of overall, I think, constructiveness as we go on. Occidental, OXY, is one of the charts, one of the top performing names today in the S&P. And if you, as you look at the chart, I mean, you could just see this beautiful strengthening pattern. This is a chart that I feel like in any environment is showing renewed signs of strength. You have resistance levels that are eclipsed. You see pullbacks that that finish up higher than the previous pullbacks. You're bouncing off of the 200-day moving average a number of times. Most recently, we broke to new swing highs, and that swing high there in October is around 36. We broke out there, pulled back, and even bottomed out above 36. We're holding that support level, that potential support level, now rotating to the upside. So you have a pretty clear area of support on the previous swing lows, and the breakout level sort of in that 36 to 38 range. Long and strong with the chart rotating to the upside. And it's not just that one, obviously. Most energy names kind of look similar to this. DVN is a name we've highlighted for quite some time. I know to our premium members and on the show we've highlighted it. The relative strength is, I think, the best part of this chart. Besides the fact that the trend has just been consistently positive, the fact that the relative strength keeps going up, that's the type of name you want to own. I would love to own a portfolio of names at all times where the relative strength is sloping to the upside. That is the way that you consistently beat a passive product like the S&P or the NASDAQ, is by owning stocks where the relative strength is going higher. By the way, in our large cap universe, this is currently the top ranked stock out of all of those large cap names, DVN in the energy sector. What else has looked pretty good? We talk about agriculture names, talk about materials stocks like Mosaic, MOS, with a nice rotation to the upside, similar to the chart of Oxy. You look at the resistance from October, we hit that again in January, we broke above it, test it from above, that's right around 42, 42.50. That's now holding it, so you have the 50-day, you have the previous support level right around that same area, so it's a nice sort of clear, natural stop. And when I say that, I mean a clear point on the chart where it's obvious buyers have come in before, and so the assumption is if we pull back, that's probably where people are most likely interested in buying a chart like this. And so overall, you have a real clear level to pay attention to if you would get into a name like this today. Now, Berkshire Hathaway reported before the open today, and you can see it's off a little bit. Most of the financial stocks are down. Berkshire overall has been a really interesting story on a relative basis. So since the market topped out in November, how I would describe it as topping out, since there, Berkshire's been a pretty good relative bet. What's interesting about this chart, and why I think it's important to watch right now, is you're in sort of a consolidation pattern. I might call this a coil pattern, maybe, where you have a big run higher and then you have sort of a consolidation phase. It's not a great coil, because a coil you'd really want a lower high coming in here. This is almost more of an ascending triangle pattern, is I guess what I would call this if I had to label it. But it's basically a consolidation pattern where we're settling into an equilibrium right around the 50-day moving average. And I would love to see if this could break out of that range to the upside. You need to get above 490,000 on there. And if you're trading the B shares, it looks very, very similar, but the level's a little bit different. That's around 325, 330 would be the resistance area. You want to see it get above there to really indicate a follow through to the upside. But a lot of financial names, as we'll get to in a few moments, not looking nearly that positive. Now, we did a poll question last week, and I asked about the generals, and someone pointed out I forgot one of the generals, and I was thinking of the chart room and Fidelity, and I remember thinking, what were the general? I remember General Electric, I remember General Motors, I remember General Reinsurance. I forgot General Dynamics, a big defense name, obviously, and one of the better charts. If I had given that, made that as one of the four options, maybe this would have gotten some votes. But a nice follow through with, understandably on some of the aerospace defense stocks like General Dynamics. NOC, similar, Northrop Grumman, and a lot of these other names, obviously, reaction to what's happening in Europe right now and potential further escalations. But defensive stocks overall have been doing pretty well up until today, but really seeing some follow through to the upside on those names. And again, the concern with a chart like this is, are you chasing it on a day like today? And I totally get that argument. So a lot of times what you do is wait for some sort of pullback. You don't want to necessarily buy on the day that it's shooting to the moon. However, there will be a natural fluctuation. There will be a time when it gives back some of those previous gains. And that might be what you look for on some of those charts that have been going up so much recently. Talk about gold stocks, and I would not say gold stocks are fairly overextended at this point. To the contrary, I think these are still earlier on in that play. If you buy into the theme of higher inflation, which I think makes sense, if you're buying into that idea that the Fed is probably raising rates here starting very soon, and there will be a lot of discomfort related to that, most likely gold ends up being a pretty decent bet. You really haven't seen it materialize yet. And what's interesting is it's getting above the 200-day moving average as we're looking at the XAU. It failed to do so back here in July, August of last year, here in November of last year. In January of this year, all of those were failed attempts to get above the 200-day. This one looks like it's actually working. So holding the 200-day, obviously pretty important there. But overall, I'd love to see if it can get above the November high, which means the XAU gets above 145. It does that. I think that might indicate the next leg higher to potentially higher highs. A lot of movement in renewable energy. Now, this is a group that's actually tough to bucket. So some, service providers that I've seen, some platforms bucket these sorts of names within energy. The problem is it doesn't trade like the other energy, sort of like new energy, which most people bucket more with technology, and that's kind of where we have them. So it's solar stocks, battery names like Plug Power, Enphase, ENPH are all in this group called renewable energy equipment. What's interesting about these names, they all jumped really nicely today. There's some of the top performing names, but a lot of them still have some work to do before they get above their previous swing highs. With ENPH, I'd love to see it get above the 200-day. It failed to do that earlier in the month of February, and that could be good as well. Plug Power did get above its swing high from February, but a little more to do before it can get above the 200-day moving average. It should be around $29, which is not too far above where we're at right now. Etsy's another one. Etsy looks a lot like the chart of Plug Power here. What's interesting about the chart of Etsy, though, is what I would call a clear bullish momentum divergence. You have lower lows January into February. You have higher lows in the RSI. And so what that is telling you is that the price is going lower, but the momentum is actually drying up. So on this last attempt to make new lows, you have a bullish engulfing pattern as the RSI confirms a bullish momentum divergence. That suggests the path of least resistance on something like Etsy is most likely higher. Now, this is an early earnings name last week, and so potentially continues to break above. I like the fact that it got above the February high here today. Just to finish off, because I promised I would do it, financials not so great. Citigroup is a tough chart, and a lot of these are very similar. Failed to break above resistance earlier in the month, now testing lows, and Citigroup's actually undercutting its January low. Another one I picked out was State Street, STT, breaking below the January low, breaking below the 200-day moving average. These are stocks in the distribution phase. I think financials may have some serious headwinds going forward as the yield curve has flattened actually quite a bit recently. We need to wrap today's show. Go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number one is the S&P daily chart. It's kind of cheating because we look at this chart every day, so it's not a dramatic addition to the 3 and 3. But the point I wanted to make here is just this declining momentum. I was asked about Larry Williams' special, and again, I would encourage you to check it out. It was really well done, and Larry obviously deserves your attention. He does a great job of laying out a lot of different evidence in terms of price and breadth and sentiment. For me, though, I'm concerned about the fact that the momentum has continued lower. When the momentum stops trending downwards, I will start getting less negative about the overall market structure. Right now, I'm seeing a market trend lower. I am keenly aware of this bullish momentum divergence, and I think that's one of the reasons why we get a pretty viable move here. You're getting a nice bounce so far. I wouldn't be surprised if we get up to the 200-day moving average, if not a little bit further. But overall, I don't think the lows are in yet for this overall pattern of distribution. Chart number two, the energy sector. The XLE is just this classic basing chart where the basing patterns resolve to the upside. I feel like when down the road when I teach technical analysis at a university somewhere, I will use this as an example of what a big base breakout should look like. It just has all the components to it. And it's a reminder that even when things start to break out, when things start to evolve, it's rarely too late. And that's something Bill O'Neill and Investors Business Daily have done a great job for decades of reinforcing that idea of buying strength, not buying weakness, but buying strength, and riding that to further strength. And I learned that from money managers at Fidelity, and I'm seeing that in charts like energy. I hope you're there, and if not, I don't think it's too late to have exposure to some charts like this. And I'm remembering a lot of conversations I've had with Greg Schnell in recent months. He's pretty excited about the upside follow-through in energy, and deservedly so. Finally, biotechs. I was asked about biotechs last week, and I didn't get to the question, but if you look at the XBI, I see a very similar bullish momentum divergence that you saw with the S&P 500. It's almost even more clear here in the IBB, another biotech ETF as well. That's lower lows in price, lower closing lows in price, and higher lows in the RSI. That's a bullish momentum divergence, which suggests some upside from here. I'd love to see if the XBI can get above 100. Folks, that is our show for today. Thanks so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.